Hi, and welcome to this week's market presentation.
Latest news.
In the latest developments regarding the peace talks to end the war in Ukraine, Ukrainian, American, and European leaders are set to meet in Berlin to discuss the progress on those peace talks. Ahead of the meetings in Berlin, Ukraine has stated that it is willing to drop its NATO ambitions in exchange for firm Western security guarantees, but they remain very apprehensive of any potential additional territory surrenders. At the same time, Russia has acknowledged the intention and said that they're waiting for a US update on the matter, with their demands remaining firmly in place, appearing to be less open to any further concessions to end the war. The EU summit to be held on Thursday, where a massive loan to Ukraine could be underwritten with frozen Russian central bank assets. Additionally, Zelensky in Ukraine is already for new elections, provided they can be held safely in one of the criticisms he has been facing as of late. Overall, markets have reacted in a similar manner as over the last couple of weeks, with limited impacts on energy pricing in particular, as market expectations remain for the war to continue with no short end in sight to the war, and in particular the ongoing sanctions against Russia.
Weather.
Regarding the latest weather forecast, temperatures across most of Europe are expected to remain above the seasonal average over the next 7 to 10 days, particularly through the beginning and middle of this week. The above average temperatures will be most noticeably felt in Northern Europe, with temperatures as much as 9 degrees above the seasonal average. Looking at precipitation, we see limited precipitation being forecasted across most of continental Europe over the next 7 to 10 days. We'll see more rain in southern Europe throughout the week and also in parts of northern Europe. Looking at wind speeds next, we see a decrease in average wind speeds across Europe, particularly as we move through this upcoming weekend and into early next week.
Macroeconomics.
In the latest macroeconomic indicators, we have the November inflation data for China, which showed a slight increase in the year-over-year inflation rate in November, with core inflation remaining steady. Overall, the slight uptick in year-over-year inflation is seen as a positive sign as the Chinese economy continues to face deflationary pressure, and this could be a sign that the measures taken by the central government are starting to work. But yet to be seen if this will be lasting improvement on this area.
Crude oil and LPG.
Looking at crude oil prices, we note the further downward movement in both WTI and Brent crude oil over the past week, with decreases in the front month of around 4% each. Overall, crude oil markets globally continue to face the bearish pressure from the oversupply expectations expected to take place throughout the first half of 2026. We do see some bullish factors that are potentially limiting further downside, namely the continued Ukrainian attacks on Russian infrastructure, as well as the rising tensions between the US and Venezuela that could lead to a reduction in Venezuelan oil exports. On the bearish side of things, however, industrial production has slowed down globally, particularly over the past couple of months, denting future demand expectations. We do see the Russia-Ukraine peace negotiations offer some optimism or some hope that we could see a reduction or elimination of the ongoing sanctions against Russian exports. But as I mentioned, that is still at this moment appearing somewhat unlikely in the short term.
Natural gas.
In terms of natural gas prices in Europe, we've seen a slight downward trend, particularly further along the curve. For the front here, we did see limited movement over the past week, with pricing remaining somewhat stable, although there was a very slight uptick in the price for the first quarter of 2026, with prices moving up by almost 1%. When we look at storage levels across Europe have fallen to just around 72.5 percentage points full. That is a noticeable deficit versus the previous year, with a 10% deficit there. Nonetheless, the deficit versus previous year has been narrowing over the last week in particular, owing to the lower withdrawals from storage versus previous years, very much due to the warmer weather conditions we had across most of Europe over the last week and a half. The deficit versus previous years, as you can see, has been narrowing across the board, but in particular, looking at deficit versus last year, narrowing closer towards just under 100 terawatt hours. Nonetheless, the lower storage levels at this time of year versus previous year is adding some bullish pressure on the market. Could be one of the drivers of the slight uptick in pricing for the first quarter of 2026. Looking at total supply and demand, we note the decrease in total supply, largely due to a drop in LNG sendouts, while total demand remained very responsive to weather conditions, having decreased to multi-year lows on the back of the unusually warm temperatures we've been having. The drop in LNG sendouts has been in part as a response to the lower demand due to weather conditions, but also responsive to the ongoing price trends as well. Overall, LNG imports into Europe have continued to increase over the last few weeks, reaching close to an annual high, as we saw at the end of last winter. And overall, LNG imports remain near the top of the range over the past 5 years. Overall, Europe continues to highly depend on US LNG exports to meet its LNG import demand. And given the price evolutions between Europe and Asia, we do see a significant margin between Asia and Europe, with current pricing noticeably favoring Europe as a preferred destination for US exports. Lastly, investment fund positions and investment fund market participants continue to hold a bearish sentiment in the market, with the level of short positions continuing to increase, pushing up the level of net long positions further up.
Coal.
Coal prices over the past week have seen a slight downward trend week over week, with prices decreasing around 2%. Overall, we continue to see lower gas costs and higher EUA prices, limiting coal-fired generation in Europe, owing to the limited demand for new arrivals. Additionally, we do see sufficient near-term supply of coal across Europe, with ARA coal stocks at a 5-week high. Nonetheless, in Asia, we do see an increase in additional imports, in part due to the current levels of domestic production and expected demand, as we still see some risk premiums being added due to the concerns over winter conditions.
EU and UK emission allowances.
In terms of European allowances, a further increase in the level of European allowance prices, moving up around 2.4% in the spot market and 2.2% for the December 25 product. Prices over in the UK market remaining more stable, with limited movement week over week. Overall, we do see the free auction period this week expecting a tighter supply of free allowances, with 35 million tons having been removed. Additionally, we continue to see the expectations for a tighter EU ETS market in 2026 add upward pressure to European prices. On the UK side of things, the ongoing UK and EU ETS linkage negotiations adding upward pressure to the market. Looking at the power sector emissions, we do see those over the past week at a multi-year low on the back of the reduction in coal-fired power generation, but also a slight increase in the share of renewables as well. Overall, market participants remain bullish when it comes to European carbon allowance pricing, with the level of net long positions continuing to reach new record highs.
Electricity.
Electricity prices over the past week have seen a sudden uptick in the market following a pretty steady bearish price evolution over the previous few weeks. The uptick in pricing more concentrated in the short term and driven by an uptick in the price in the first quarter of 2026 of 1.8%. The main driver of the uptick in electricity prices being the slight increase in gas prices for the first quarter of 2026 and the continuing bullish price evolution of carbon allowance pricing, increasing overall generation costs for electricity. The slight uptick in the price level was felt across European markets, as you can see here, both in continental Europe, but also looking at the Nordic market as well. Looking at the fundamentals, we note the decrease in total grid demand, in part due to the warmer temperatures, reducing total consumption across Europe. And we also see that residual load has similarly decreased as well. In terms of the European supply mix, we note the 5-year high level of nuclear generation from France, helping improve the overall nuclear power outlook for Europe, and one of the bearish factors in the market. Looking at the output for renewables, there we saw a slight uptick in solar power generation, and then wind power output has seen a drop week over week, given the less favorable weather conditions. Then looking at fossil fuel power generation, we see the higher levels of output at this time of year, but nonetheless, current fossil gas generation remains below the past 5-year average. Looking at coal, and as we mentioned earlier, we still see coal-fired power generation at the lowest levels in over 5 years due to the low gas prices, high prices for carbon allowances, and the overall lower demand for electricity at the moment. Lastly, looking at guarantees of origin, we see a slight increase in the price level, especially for the 2026 production years on a percentual basis. On absolute terms, we're looking at an increase of just a few cents week over week. Overall pricing remains near the lowest levels we've seen over the last couple of years, and that has been largely due to the very high levels of total renewable power generation throughout this year, with solar at a considerable record high and with wind power generation inching closer towards the high level we saw last year. That covers this week's market presentation. Thank you for joining.